Okay, so this question will be focusing on how best to approach arbitrage in a given company. So you have been given the following information. The ABC company and the BBC company are identical in every respect except that ABC is not levered. The market value of BBC company is 6%, bonds is 1 million, and then financial information for the two firms appears here. All earnings streams are perpetuities. Neither firm pays taxes. Both firms distribute all earnings available to common stockholders. So you've been given the information for the two companies there below. What benefits, if any, can an investor who owns 5% in BBC company derive from arbitrage? So first of all, you need to know what are the capital structures? How are the earnings structured in each company? That's how we need to first establish before we even start the arbitrage process. So basically what we have done is this is basically the capital structure for ABC and for BBC, and then what you just need to do is calculate the returns that are gotten from both entities. So one of the entities, they initially told us that the market value that it has is 240. So you get the entire 240,000 there, and then just a minute, you get the 240, but we'll use this formula. We need to know the return that they get, because this is an all equity company, so you can just use the KE formula, by the way, which is the EAC over your S. So your earnings after available to common stockholders are that 300 that we had found. This one here, according to ABC company, yeah, that's the earnings available after removing interest from EBIT. So that over the 240 there. This should give you 0.125 as a return from company ABC. The other company, they gave us according to the BBC side, yeah, so we had 240, and then you're supposed to now also divide. But to get into it, we need to now go and see how much this investor first owns. So the investor owns 5% of BBC company, and in that case, what we're going to do is this: 5% of the equity in that company. Okay, 1,714,000. This gives you how much? 85,000 ownership. That's what belongs to this person. But remember, even the debt that is on the company has to also be split amongst its shareholders. That's how it is. That's the limited liability aspect of a company. So it's shared amongst the shareholders there. So that's a 50 there. So meaning, what is the total ownership here? This person in BBC has got 135,000 in total. So this means, because the S part or the equity part is the 1714, it was given in the question already, and then the debt part was 1 million. So I'm just getting the 5% from each part here. So then from there, that's the total earnings. Now let's see. So that's like the cash available that this investor has. So now if the investor takes his money to ABC, now from BBC he takes his money to what? To ABC. What is the return that you get from what this company called ABC? We found it as 0.125, if you recall the figure was just from calculating for ABC. That is the return he should be expecting as he puts all his entire 135,000 in ABC. This will give him a return of 16,875. 16,875. So that's the figure. And then remember that there's some interest that will be being paid. Remember, debt comes with interest, so that has to reduce your earnings or any return that you'll be getting. So the interest will be that the loan initially had the total interest payable towards it of how much. So like I was mentioning, for the debt part, remember you had first of all, you own 50,000 of the debt or that entire bond. Now you're going to be paying some interest on your portion, which is the 6% of this. It should be about 3,000. So now therefore you will get your earnings first, your 16,800 and what, 75. Remove interest that you will be paying off. This is giving you how much? 13,875. So that 13,875 now will be your net gain or net benefit in this company. Then now you get to compare now. What were you getting at BBC? For example, what was the outcome. What are you getting at BBC? So at BBC, they remember that there was the value of equity was this, right, at BBC company. Then we did not even calculate the equity return on this, so you need to just use the same KE is equal to the same one we used earlier on, EAC over S. So the EAC is 240 according to BBC's capital structure, if you recall, and then 1714. This gives you 0.14. So this is the return that this company gives. So go ahead and multiply your 0.14 multiplied by 1714 like this, but then times your portion held, which is 5%. This gives you roughly rounded off to 12,000. So compare your 12,000 with your 13. That 13 that has been left outside on top here, the 13,875. You will find that there is actually a net gain of 1,875. So you compare this. So what I mean, 1,875 as a what? Net gain. So you would be gaining more if you are asked to interpret this. You will be gaining more by investing more your cash into a BC company. Yeah.